Okay. Let's get to it. So, as we have here, we have the advanced financial management. And before I move on, Folu, I would like to confirm: are you from the ICAN space or ACCA direct? So let me confirm that, please.
Okay, I'm from the ICAN space.
Okay, so you're from the ICAN space. So it means you didn't pass through the financial management for for ACCA. Well, so that's fine. Yeah, so that's fine and that's good. Also, I can tell you also that I'm also from the ICAN space, right? So I converted from ICAN to ACCA. So you are in the right place. Let me start with that. And no cause for alarm. There is no fear in this. Is You should know, for you to have passed through ICAN, that means you are grounded, heavily grounded, and every knowledge that was applied in ICAN is also obtainable here and it's also applicable here. So you are in safe hands and you are on the right track. I just want to give you that assurance, right? You don't need to be scared. Yeah. So I was the is it that was SFM, right? I was SFM in ICAN. How was it?
SFM was not really easy for me. So that was 8 p.m. So I don't know what financial management is all about. If it's something like PM also, like SFM.
Well,
Is it?
financial management is just like SFM. Or
Re-
S so but SFM is closely related to advanced financial management. So FM is just like a lower level, right? So it's still part of it.
Okay.
Yeah. So FM is just to give you a foundational background of what you are to expect at the advanced financial management level. So
Okay.
let me just to clear your doubts. Let me move to coming. So can you see my screen? Let me show you the link between AFM and FM. So under AFM, right? We have
Yes.
AFM at the we have AFM, the one with the red and blue lines. Can you hear me clearly, please? Or am I breaking? Is the
No.
network okay there? Okay, you can hear me clearly. Okay, that's nice. Okay, so for the AFM, you can see the red and blue icons. So these are the five strategic areas cover in the advanced financial management. It talks about the financial management. So in advanced financial management, as an advanced financial manager or advisor, as the case may be, you are expected to understand the role of the of international organization. We are not expecting you to know nothing less than this. It means that you are a grounded person and you're supposed to be operating at the capacity of a senior financial advisor. So as an AFM graduate or affiliate, as the case may be, or member, you're expected to what? Know the role of the senior financial advisor in the multinational organizations. One, you're supposed to understand advanced investment appraisal. I know this advanced investment appraisal is something you understand in SFM, in ICAN, but we are going to be brushing through because at this stage, we assume that you understand these things, right, at the basic level. Let me put it that way. I don't want to assume that you understand it at a technical level, but at the basic level, I believe you understand the net present value, NPV, free cash flows, IRR, payback period, and decay, and all the likes. Are you familiar with that, please?
Yes, please.
Okay, thank you. So that's the expectation of advanced investment appraiser. And why do we do advanced investment appraiser? Advanced investment appraiser is just to, okay, I want to diversify into this business. I want to embark on this project. I need to appraise the investment if it's worthwhile, right? If it's worthwhile. So that's just an overview of advanced investment appraisal. So after advanced investment appraisal, you are expected to understand acquisitions and merger. So deals like, for instance, now, I don't know if you on the work on the recent how will I put it, the recent buyout for Seplat. Recently Seplat bought Mobile and took over the company completely. So those are examples of acquisitions, right? And we also have examples of merger. Like for instance, I don't know if you know about Access Bank. Access Bank is big on mergers and acquisition. If you'll be following the market and trends, you'll see how we heard how Access Bank merged with Diamond Bank, how Access Bank acquired Intercontinental Bank and the like. So deals like that, as an senior financial advisor, as an ACCA graduate, you are expected to understand these things. So when people are talking about these things, you should be able to speak clearly to it. You might not be deep on it because being deep on it is based on experience, but at least the foundational level, the background, the at the lower career, you should be able to speak to it. That is why you are an ACCA graduate. Business
Okay.
is running. Oh, what do we need to do? What do we need to do? What do we need to change? How do we change the face of the business? How do we change the operational structure of the business? How do we change so many things about the business? Those are what we talk reconstruction and reorganization, right? So we are going to be going deep on it, but this is just an overview. And lastly, we go into the treasury and advanced risk management. So treasury and advanced risk management is the part of derivatives, right? Using derivatives to hedge and all the likes, where we have the futures, the forwards, the swaps, and interest cooler and the like. So it's a very interesting um topic or course. Let me put it that way. It's an interesting course and it's very very practical. So you don't need to be scared. Just be passionate. Just pick an interest in it. Yeah, let me put it that way. Pick an interest in it and you will enjoy it. To be honest, advanced financial management is even simpler than reporting to me. This corporate reporting and the likes is much more simpler. And between me and you, when I was in ICAN, I don't know, as every other, do I have more people in the class? Because I'm not, let me check. Okay, so I think I have like two more other persons. Okay. I have Joseph Oni, I have Kemi Amos. Okay. Joseph Oni, Kemi Amos, welcome. Welcome. Okay, so I think I have so please, if you are not speaking, you can mute your mic when I ask, because I love my class to be very interactive, right? So you can speak. If you want to talk, you can put your raise your hands and the likes. Yeah. So like I said, so this is just an overview for AFM. And for financial management, for those that pass through ACCA, you would have done investment appraisal at the foundational level, like I said, business finance, business valuation, and risk management. It might not be technical, but at least the foundational knowledge of it, you would have gone through that. So, Kemi, I believe you have an overview right now.
Yes, sir.
I'm sorry, follow. Yeah, sorry, follow. Yeah. Okay, so let me start. So, like I said, advanced financial management. This is the overview, like I showed you earlier. So, it's expected to understand the role of a financial advisor in an international organization. You are expected to understand advanced investment appraisal methods, right? How we appraise investment. It might be MPV, it might be IRR. It is very important. We have mergers and acquisition. Yeah, we have business reconstruction and reorganization, and we have treasury functions and use of financial derivative. I will advise you, please start laying your hands on this material. How many of us are writing? Is it? I think we have September diet and December diet. How many people are writing September diet? Is there anybody here writing September diet? Kemi, Amos, Follow. Anybody writing September diet, or is it December?
December.
Okay, December. That's fine. That's fine. Now that would be my best advice for you. Just do December. Give yourself 6 months to prepare. I also gave myself 6 months to prepare. And like I said once again when I was speaking with Follow, you are in the best and good at what they do. I like I said, I passed through the ICAN class, and when I did ICAN, when I did the SFM. I didn't really can anyone hear me, please? I think I lost everyone for like 30 seconds. Can you hear me now?
Yes, we can.
Okay, apologies. The network here. All right. So like I said, where did I stop, please? Where did you hear me stop, please? Folu, are you there?
Yes. You were talking
So where
about
did you
to write SFM in ICAN.
Okay, so yeah, so like I said earlier too, I struggled in ICAN for the SFM part and the risk management. But whichever way I passed, and I think I had over 60%. If I'm not I had over 60%, if I'm not mistaken. Though it was a struggle because I didn't really understand those terms. But you can mute, please. You can mute, follow. You can mute, follow. Your network is breaking. So yes, like I said, I struggled with the call support. I was able to also when I came to ACCA, I took my time because I told myself I needed to understand this course. I needed to understand this course. I needed to know why and why what I'm reading. Why what am I even reading? I didn't just want to cram. I wanted to understand. And yes, I really understood it. And upon understanding, I came out as the top 3 best Nigerian student at ACCA level, advanced financial management. Yeah, so I will also be assisting you to achieve that if that's truly what you want and you just don't want to pass only, but you want to understand and you want to be able to apply it in your work ethics and environment. So let's move on. So this is the overview of AFM. I've talked about the link between AFM and FM, right? Where we have the advanced and the financial management and how they link together. So that is that about that. Kemi must have not heard your voice at all. Are you there, please?
Yes, sir.
And are you following?
Yes, sir.
All right, thank you. So yes, let's move on. So now we move to the format and style of the exam. I don't know if we've checked how the format is, but the question is usually 3 hours 15 minutes, right? 3 hours 15 minutes, and for question 1 we usually have 50 marks. So question 1 is a full case study, right? Depending on how the exam style is, it can be very big, it can be very short, but just know you are going to be having a 50 marks question. So it's not something you should joke with. You should take it with high seriousness because the probability of not understanding question number 1, I don't think there's any pass mark anywhere. Because if question 1 takes 50 marks, then is it something to be joked with? No, you can't joke with it. So question 2 and question 3 carries 25 mark each, and you have 3 hours 15 minutes. At this point, if I were you, I will look at 3 hours 15 minutes, convert it to seconds, and divide it by 100 marks. So you will know how many minutes is expected for every marks you are trying to get. You have 100 marks, and you must get those 100 marks within 3 hours 15 minutes. So ACCA is strictly time conscious, right? 3 hours 15 minutes is 3 hours 15 minutes, right? I'm doing all this preparatory explanation so that you can have an idea of what is at stake. So 6 months is not long. 6 months is very short for advanced financial management. Some people even use up to a year to prepare for advanced financial management. So you need to start now. The table and rearrange it better. Those are the kind of students I'm interested in. So For the advanced financial management, we have question 1, like I said, 50 marks. We have question 2, 25 marks each, right? So that's 100 marks. And in the question 1 is like a report writing. So, like I said here, general report format and structure. So it's like a report writing. You are writing a memo as a senior financial advisor, maybe to the board of directors, or maybe to the chief financial officer, or whichever way, or to a client. But mostly it's usually to the board of directors. So you need to understand memo style of writing, right? Which we have like to, from, subject, and the body, introduction, the and every other supporting lines that you need to. So you need to understand that style. Over time, will have a session on how to draft a report and how not to waste time in a report writing. So, like I said, the style, language, and clarity. So appropriate layout and tone. So in advanced financial management, you're not here to be speaking like a layman, right? We expect that you've gone through financial management. So the kind of vocabularies we expect from you is what is high level. Note that, please. As you are reading, you have to improve yourself in your language and style of writing and your tone of your report. You are not a clerk or clerk, whichever way. You are not one of that. You are a senior financial advisor. So you are talking from a place of authority and knowledge, right? As a professional. So that is what is expected from you. So your language, your style, your clarity, your tone, your usage, it must show that professional touch, that this person knows what he's saying. So those are the things your examiner are looking at. Those are the things they will use in grading you when they see the way you write. Some people might even be amused by the way you approach your writing. And one of the things that helped me, there are some questions I didn't really know, but I will tell you the truth. My style of writing is on point, and my format. I underline properly, I bold properly, I put my format properly in the right way as it should be. So that even when the examiner, because in advanced financial management, right, it's not only about what you write. There are some other cheap marks that you can get. If you've seen a past question before, you'll see questions like 10 marks for professional judgment, skepticism, style of writing. So in advanced financial management, you can get those cheap marks if you know what you are doing. Even if you don't know some questions, there's some questions that in the 50 marks questions, up to 5 or 10 marks, if I'm not mistaken, is awarded to what? The way you write. So even the way you write, the way you structured your memo, right? Your memo report will go a long way when giving you some extra marks other than even writing. So in this examination, the examination is not just la cram la po and I come to write. No. I'm using this moment now to just break these things down so that you see how you can make maximum use of your time and marks. Like I said, that was one of the things that helped me, right? It really helped me. I knew, okay, what does the examiner want in terms of style and report, right? And also what he wants me to do and what does he want. So we go next, effectiveness of communication. The answer has to be relevant, specific, focus on the requirements. ACCA is not a place that you just write and you think that, I will see 1 mark, I will see 2 marks. Convert it if it's just 5 marks or 6 marks. No, ACCA is not like that. Go straight to the point. There's no time for story. Your report, some points, there was no need to even, it's not supposed to be more than 2 words, not 2 words, 2 sentence or 3 sentence marks. I've seen some people, they will write the whole page and you will still fail. No, that's not what ACCA is here for. ACCA just wants it to be specific and focused. If they're asking you definition, if they're asking you to appraise something, just 3 sentences is okay. Please note these things down because they will help you in the long run so that you won't go and waste time. I'm telling you, at ACCA level, 3 hours, 15 minutes, it's just like 20 minutes when you start the exam. Time will be flying. So you need to go straight to the point, be specific and focus on the requirements. Don't beat around the bush. Right? Are you following, please? Are we there?
Yes, sir.
Okay, thank you. So I've spoken about the exam time and effectiveness of communication and also the use of the Word document and Excel too. For some of us that are coming from ICAN, right? It was difficult for us because in ICAN we calculate with pen, right, on paper. But at ACCA level, it's not like that. We write on Word documents, right? There's a test-rich platform where you can use to practice. You can chat me up on how to go about that. You will see it if you start using those platforms. So that I will encourage you, please, if you want to start reading now, that is my best way to advise you. Don't use paper and biro. I'm telling you, don't use paper and biro. If you've not yet registered on ACCA or you can't access the ACCA platform or the tertiary platform, start using normal Excel and Word to answer questions. That's my best advice for you now. Forget biro and pencil at this stage, or biro and paper. What you need now is Excel and Word documents so that you can start practicing your speed level, because you need speed. Your ability to know how to use Word and Excel very well would go a long way in passing this examination. So at this stage now, start using what? Start using your Excel for calculation and the Word documents for what? For writing, because that is what you meet in the exam under that time condition of 3 hours, 15 minutes. And I'm telling you, it's easy if you start now. Thank you. So let's move on. So that is that. I just need to speak about the style and the approach to which for the exam. So we move to the first topic, which is which we'll be talking about the role of a financial advisor in international organization. So this is it, the role of a financial advisor in an international organization. So what's the role of a financial advisor? Why do I want to employ a financial advisor, right? Why? First of all, reason why I need an advisor is because why? I that started a company, right? I have a vision for my business, right? I have a vision, whether it's articulated or not. That's the foundation of the company, and it set out the direction and values of that company, right? Know the word direction. Where are we going? Where are we investing? Are we investing in Nigeria? Are we investing abroad? What are we selling? What industry and the likes? So there are so many things that makes up a vision statement of a business, right? So a company will always have a vision, whether it is what articulated or not. And after our vision, we move to strategy, right? Okay, I have a vision. How do I achieve this strategy? Then there has to be some strategy documents. So in some companies, you will see them having 5 years strategy cycle plan, right? What I need to achieve between 2020 to 2025 or 2025 to 2030. So most businesses usually have a corporate strategy plan of maybe 5 years or 10 years. But 5 years is better because why? 5 years you can predict effectively within 5 years. In 10 years, I don't know what can happen in 10 years. So many things can happen in 10 years. Look at businesses now. Some people did not expect COVID-19 when it came. It disrupted a lot of businesses. Some businesses had to close down. Some businesses had to pack up. Because why? It's a strategy plan. It does not have to be 10, 20, 5 years plan so that you can work effectively. So those are the things that you need to start knowing, because as a corporate financer, finance advisor, or corporate finance officer, these are things that we expect you to start speaking. These are your languages now. So strategy plan, and in the strategy plan, it's broken down into corporate strategy. Like it answers questions like, what business should we be in? Okay, what business should I be in? Is it in the food business? Is it advisory? Is it investments? Is it the banking sector? Is it the agricultural sector and the likes? So those are what corporate strategy talks about, and is more detailed than what you have here. So we have the business strategy also. How should we compete? How should we compete? Which style are we using? Which approach? What cost optimization strategy are we using? Is it to be the cost leader? Or are we providing a niche for our business? Is it cost leadership where our price will be very low and we'll gain market? Are we doing a product differentiation whereby we only have a target market like iPhone, where it's luxury good, but people will buy it because it's luxury, right? Or a techno product, which is cost optimization. They want to be the cost leader. Their prices are very low, but what they want a larger market. So how should we compete? Those are business strategy plans, right? And we now go down to operational strategy. How should our strategic business unit operate? Is it HR functions? Is it the finance functions? Is it the sales functions? Those are conversations around operational strategy. So financial strategies. So after strategy, we go into financial and non-financial strategies. So financial strategies include investment decision. Like we said earlier, what business do I want to invest into? What project do I want to invest into, and the kind of returns it's going to bring, right? If I invest into this project, what's the expected returns from this investment? What's the beautiful thing about a business? The main goal of a business person is to what? Is to maximize shareholders' fund, right? maximization of shareholders' funds. Shareholders have invested in this business. We are managers of this business. What do they want? They want maximization of shareholders. So we have to carry on investment that will what? That will match their returns and their cost. So investment that would provide adequate returns for our shareholders. Also finance. Saying, okay, now I want to do a business. So sorry, please, can you just give me 2 minutes? Just give me a minute, please. A minute, please. Hold on, a minute. Okay, apologies, I'm back now. I just had to attend to something. Yeah. All right, so let's move on. So like I said, so for financial strategy, like investment decision, okay, financing decisions. So I talked about financing decisions. How do we okay, we have a business plan. We want to invest. What do we need? We need money to invest, right? That okay. Sorry for the breaking communication here. So we have the financial strategy, and then we use equity or debt where to finance face in a food business, food and beverages. Can anybody assist me with that? Hello, are we there?
Yes, I had only food and beverages.
Okay, so in the food and beverage industry, what's the rate in the food and beverage industry? I can't hear anything. Is anybody speaking, please?
Your network
Okay, good afternoon.
Your network is the question is not clear. We are only hearing food and beverages, food and beverages. Network is very confused. I don't know if you can repeat.
Okay. Okay, yeah, I can hear you. Okay, so let me repeat it. So my question was in what risk is in the food and beverage industry?
Okay. The kind of risks in food and beverages should be ecological risk for my own view. Can you hear me, sir? Ecological risk. I mean market risk rather. Market risk.
Market risk?
Yes.
Okay, thank you. Anybody else want to try? What kind of risk can we find in the food and beverage industry? Follow, you were saying something the other time.
No, I was saying I didn't get the question.
But do you get the question now?
Yes, I do.
What do you think is in the food and beverage industry?
I have no idea.
Okay, thank you. Kemi, over to you.
Exploration of goods. Goods may
Exploration
the goods might expire before getting to the required destination.
Thank you very,
Then
very much. Then
my guess points also maybe due to other things like that, like tomatoes and the rest.
okay, thank you. I really appreciate what you said. That's a very key risk, like in perishable goods, right? So lastly, let me do one last question on that. Does you, how do you think we can mitigate that kind of a risk for perishable spoilage? How do you think we can mitigate that kind of risk?
Mm.
Okay, I'm with you. You didn't say, I didn't get what you said, though. Okay, does anybody want to assist her, please?
I think
How do we mitigate such risk?
from my own perspective, I think I just used just in time. Like whenever we order for the perishable goods, we sell in time without storage. Like we don't keep inventory of it. You understand what I'm saying? So like by using just time.
Thank you. That's very beautiful. Just in time approach. You can see we have so many scholars in this class. We have scholars here. It took us to just in time under advanced performance management straight. Thank you very much. That's a good one. Who else again wants to try? How can we mitigate such? Okay, so let me give you an instance so that we won't waste our time. So for perishable goods like that, one of the risks strategy we can implement is one okay, for goods that I know they are going to be perishables, we don't need to produce as much as possible, like I said, just in time. We must have a ready market. The ready market, what do they need per time? That is how we should produce those kind of goods. Not that we should just produce and store when we know that, okay, they are perishable goods. So as I'm producing, I already have a target market. Maybe my target market, what they require is 2,000 per day. So the expectation is that I should not produce more than 2,000 or 2,001 or 2,002, right? That is how the market should be. So I won't have to store any goods, just what they need per time. That's a good way of mitigating such risk. And like I said, this is advanced financial management. So the examiner expect that, like what Og said now, he spoke about just in time. So in advanced financial management, you need to read wide. Don't just read and just to pass. Look at the way he kept, let's say for instance now, they ask a question now, and he just chip in just in time. For him to have put in just in time, the examiner will know that, this guy understands what he's saying. And that's an extra mark for him, whichever way. So we have the just in time approach. We also have discounts. So when I notice that, oh, these goods that I'm selling for 10 naira,
Sir, your network is very bad. We can't hear you any longer. Is there anybody here?
Yes, we are here. We can hear him.
His network is very bad.
Apologies. Apologies, please. The network here is it's not so okay. I've been trying to switch to another network, but just bear with me for the meantime. Anytime I'm able to fix this. Can you hear me, please?
Yes, sir.
Yeah, apologies. It should improve maybe next week, but let's just bear with me for the meantime. Yeah, please. All right, so let's move on. Okay, let me know when you can see my screen, please.
Can hear you, sir.
Can you see my screen?
Yes, I can.
Yes, sir.
All right, thank you. Yeah, so let's just move on. Okay, so we talked about risk management. So as a financial advisor, you're expected to understand these financial strategies in and out. So don't just say I want to focus on only investment part or financing part. You must understand investment, financing, dividend, and risk management. That's the core of a corporate finance officer. And also we have non-financial strategies. Non-financial strategies include human resource, marketing, and product development. And if you notice, some companies, they usually outsource these non-financial strategies because they feel like, oh, yeah, we don't really need it. It's not part of our core integral function, right? And why stress ourselves? Why focus on functions like this when we can outsource them? So we can just focus on what is our real business, which is the financial strategy. So we have some companies that would outsource this human resource, marketing, and product development. Let me just give it to another company. We'll be paying them and we'll be monitoring their performance over time. So that's just the overview of a role of a financial advisor in an international institution. Let's move to the next place. So responsibility of a financial manager. So as a financial advisor, as a senior financial advisor, as a financial manager, as the case may be, right? These are the things you're expected to understand. Investment selection and capital resource allocation, right? We want to invest, we want to choose an investment, right? What are the things we need to look out for? Sometimes it's not only about profit. Profit is even one of those things that we look at in a business, right? It's not only profit. There are things related to ethical consideration. Is the business ethical, right? It's not about us making profit. Is this business, is it ethical? Is it in line with our vision? Is it in line with regulatory compliance and every other thing? So you know that look at ethical considerations. If we go and start going to how will I put it, into refinery, what are the environmental damages that it may cause? What is the effect and impact on sustainability? And you know, currently now the world is going into sustainability. We have the world companies are big on sustainability now. Even there's some finance companies that before you can raise equity or debt from them, you have to be sound on sustainability. They want to see how you are contributing to the society, contributing to the green issues and to the health, basically. Are you polluting the earth? Are you destroying value? Are you destroying economic value? Those are the things they want to see. So ethical considerations. Also, the method of investment appraisal. I'm a financial manager. How do I appraise business? Do I want to make use of the NPV? Do I want to make use of the IRR? Even there's something we call APV, right? So those are examples of investment appraisal tools that you can use in appraising a business as a financial manager. Now, we now want to, okay, the effect of this investment. I've done this investment. What is it translating in terms of impact, right? In terms of ROCE, return on capital employed. These are things that investors are interested in. Okay, you have invested my money. You've used my money for business. What is my return on the capital that you've employed into this business? Very key. This ROCE is very, very key for businesses. We also have the earnings per share. Okay, what is, based on these earnings you've had, compared to the shares that has been invested, that's the shares value, right? What is my earnings per share? What is the earnings per share? What is my stake from an earnings perspective? And also EVA, economic value added. Economic value added is mostly used for the maximization of shareholders' fund and shareholders' wealth. How has my wealth been maximized properly? So those are things that you need to look at as a financial manager. And also raising finance and minimizing the cost of capital. There are different sources of finance available, right? We have equity, we have bonds, we have different sort of equity finance. We will have something called additional tier 1 capital. There are mezzanine finance, different kinds of finance that you can raise. But as a financial manager, can we dabble into everything? No, we can't just dabble into everything. We need to look at the one that will fit into the business, right? In as much as we're raising this, there's sometimes that when you raise equity or debt in the market, it sends a signal to the market. We are going to be going into that signaling effect of the choice of financing that a business raise, and how it affect the business. Those are things we are going to be looking at. So there's a lot of interesting topic. You will enjoy it. It's practicable, right? So I just want you to know that you can do it. It's easy to pass if you just set your mind at it. It's just, you can relate it to real life situation around you. So we want to see is not lacam lapo, is understanding and showing yourself and proving yourself to be a professional. That is what advanced financial management is talking about. So we're also looking at cost implications. Okay, if I invest in debt, if I invest in equity, which one is more costly? I want to throw it to the class. Can anybody, if I invest in equity or debt, which one is more costly? Which one is more cheaper? From your knowledge of financial management or SFM. Anybody, please?
Equity is cheaper.
Okay, equity is cheaper.
Yes.
Can anybody counter that? Please, I like my class to be very interactive. It shows that you're following, and I enjoy people speaking, please. Can anybody counter that, please? In equity and debt, which one is much more costly?
I also think equity is, which one is more what?
Which one is costly? Like, which one is expensive?
I think debt financing is costly.
Okay, debt financing.
From my own knowledge, I think equity is like the owners of the company trying to finance to their own measures, like their own capital, raising it from their own purse. But debt financing is like going through external, like borrowings and the likes. So when you borrow and the likes, they're going to get interest from that. And when you don't pay back at the agreed time, the interest will be accumulating. But when you are financing on equity, if you don't pay back, it can only affect the long run of the business. But I don't think it's more expensive than debt financing.
Okay, thank you very much. Anybody else? Who have I not heard? I've heard Fulu. Kemi, I've not heard your voice. I have Ridwan, and I have there's a number here, 3. Voice according to Islamic. Can you speak, please?
I was the one that said equity.
Okay, you said
Equity.
You said equity is cheaper, right? Okay, so why did you say
Yes,
equity
sir.
is cheaper, please?
Debt is costlier than equity because of high rate of interest. High rate of interest. That is
Okay. All right. Thank you. Beautiful. Thank you. I love the way we are speaking. Okay. And Folu, where are you? Speak, please. Okay, maybe Follow is warming up. Is Follow there, please? Okay, I have Fidelis Okeke. Fidelis Okeke. Are you a student, please? Do you want to speak to that? Are you following us? Okay, so Fidelis is saying equity is costly. I'm coming. He said equity is costly because equity is using your own funding. Okay. Okay, equity is okay. Okay, is different, is in variance with what Kemi and Oka said. He said equity is costly and debt finance is more cheaper. Okay, thank you very much. Where again do I have? I have a number here. Is Ridwan is okay, Ridwan, okay, no. 384936. Are you a student, please? I've not heard your voice at all. And I would like to know your name. So okay, let's move on. Okay, yeah, so we've heard people say equity is more costly. We've heard people say debt finance is more costly. Well, from my own point of view and from my own understanding and deep research, it can swing both ways, but generally, debt is more cheaper. I was expecting people to say why. For those that said equity is cheaper. So
Why,
yes,
sir?
why debt is more cheaper because why? When you use debt, right, to fund your business, there's a tax savings. There's a tax savings when you use debt that you enjoy. And let me explain it. When we say tax savings, normally before you get your profit before tax, right? For equity holders, is after we take interest, after we take profits, after that's what we share to equity holder, right? But for debt holders, if I'm going back to reporting and financial reporting, right? After we deduct our cost of admin and all the likes, operational cost, you deduct the interest, right? And that interest is what? Is the interest you pay your debt holders. When you deduct interest, is the remaining portion that you pay tax on. Are we following? Is I want us to be attentive. It's the remaining portion you pay tax on after you've deducted interest.
Yes.
After interest, we get profit before tax, right? So
Yes.
after profit before tax, that's when we now charge tax. Do you know that
Yeah.
if you don't pay, if you don't raise debt, and you don't, if you don't raise debt, it means that you don't have any reason to pay any interest to anybody, right?
Yes, sir.
So it means if you don't raise debt, right? If you don't raise debt, it means you don't need to pay any interest. It means that the tax you are going to be paying is going to be on a higher PBT. Let me give an example. Let's play with Excel a little bit so that, because this thing I'm explaining to you, you will need this very well in this exam. Tax savings is a very crucial part. Apologies, let me open an Excel. Let's just play with numbers. Let me know when you can see the Excel, please. Can you see the Excel?
Yes,
Can we
sir.
all see my screen, please? The Excel.
Yes, sir.
This, for instance, now we have this. We have this PBIT. Right? This PBIT, profit, right? I have let's say I'm even using 250 for both so that we can see the comparison. This guy pays interest. Company A pays interest of to debt holders because he's using equity and debt finance. Let's just work with that. Whereas company B is only using equity to fund this business, right? Company A is using equity and debt to fund this business. It means that it must pay interest to what? To debt holders, right? Yeah. So this. Let's have this. This I want you to be practicing going forward now for this exam. Use your Excel to practice. Don't use Biro and book anymore. use this, go on Excel and work straight so that you can start getting used to it. So interest, it pays 5% interest. Let's say debt raised, right? Let's just put debt as the debt raise was let's say 500, just for instance, and the interest is 5%. Let's just put it that way. So it means it pays 5% annual, 5% multiplied by 500 on a yearly basis, right? So I know I told you that question. Company A, company B is just equity. So it means that company A will have to deduct interest from its PBIT, right? So it's going to deduct this interest, 25, right? While company B is only on equity, so it does not need to fund anything, right? So this. So what do we have? We have PBT. So PBT now for company A is 225. While for company B is what? Is 250, right? That's why I was explaining the what have you. So 250, right? Now I want to pay tax. This is my tax. Let's say tax mostly, tax is usually at 30% or the likes. Let's do tax at 25%, right? So at 25%, this is 25%. So this is the tax company A will be paying, right? Why company B? So please, what did you notice? Anybody, please? What have you noticed?
Tax for company B.
Tax for company B, right?
Yes, sir.
Why for company A what? 56. So some of us, I know we are scholars, we've known this prior to this time, but for those that don't really understand it, this is one of the reasons why some companies raise debts, right? Because they are going to enjoy tax savings. It's more simpler like this, but on big corporate level, there's a lot of tax savings you gain from using debt to finance your business. Is that clear? Do we get this? Do you need any further explanation on this? So it means company A, right? So see this, company A has enjoyed a tax benefit of what? Of $6 or ₦6, depending on the currency. Because B is paying more than company A. So company A has enjoyed ₦6 in what? In tax benefits. That means it won't be losing this money. So those are reasons why in businesses we say what? Debt is more cheaper. Debt is more cheaper, debt is more faster, debt is more faster to raise. In equity, you can take like 1 year or 2 years to raise equity. How many of us are aware of the recapitalization strategy by the CBN to international banks, with them banks in nationalized or the likes? How many of us are conversant with that? Anybody here conversant with that? Do I have people in the class? If you're not conversant, don't say no, so we can move on. Anybody conversant with that, please? The recapitalization strategy, recapitalization plan by CBN. No, right? Okay, so if we have been following, so please, you're now an advanced financial manager, right? So you have to understand the capital and equity, debt market very well. Now you have to be confident. I'm encouraging you. It's not a sin, but it's just good, right? It's just good to have those things. So if you notice, banks have been before, banks were giving banks were being told to raise equity above their minimum capital base. So the minimum requirement before used to be around 50 billion or so, but now central bank has come now and have said banks have to raise capital, and the minimum base must be 500 billion. So for banks with for instance, DSIB banks that are systemic, right? They are meant to raise nothing less than 500 billion. 500 billion in shareholders in capital, those share capital and share premium. Retained earnings is not part of it. Your share capital and your share premium, the minimum you must raise must be must be 500 billion. So most companies now, most banks now are running helter skelter to raise equity. That's why so many things that have been happening. Fidelity is sharing shares, Access Bank is sharing Zenith did their own. So everybody has been entering what the UBA2 has concluded, if I'm not mistaken. I think UBA2 has concluded. So we have some banks that have concluded that equity raise. So some, it took them like 6 months, it took some like 7 months, and some, they are still on it. It's going to take some like 1 year, right? So what am I trying to bring out here? I'm just trying to let you know that when you are in 1 minute or 2 minutes, months, it can take like 1 year. And also there are some costs related to equity, agency costs and the likes, right? So, but debt is easier to raise, right? Debt is easier to raise. You can go to the market now, get an institutional investor to just come and invest in you, or maybe strategic investment, in structured finance lending and the likes. So you can get some businesses that would also want to pump money into you, and and it might not take more than 2 months or 1 month safe, depending on how you strike the deal and bargain on time, right? So most times people prefer to use debt, right? Because why? It's cheaper sometimes and is easy to get on time. But the flip side of it is that debt, you cannot, when there are issues, you have to settle your debt holders as soon as possible. Equity, you might have issues and everybody will lose. But in debt, you have to pay your debt holders. So that is another good side of what equity, right? So you have to, as a financial manager, you have to look at both sides. In equity is we are the equity holders. Equity holders means that last resort. If the business go bad, whatever is remaining, that's what we share. But when the business go bad, when we want to settle liabilities, we start with the debt holders first. Because why? They actually invested their money, give them their money. So most people will also prefer to do equity because of all this advantage that, okay, I can decide to, for debt holders, if they say it's 20% they want to collect, we have to be paying them 20% yearly, whether we like it or not. Equity holder is whatever is remaining. If it's 5 kobo I declare today, collect it. If it's 10 naira I declare today, if profit is plenty, collect it. So equity holders are usually called residual holders. Whatever is remaining, that's what we share, right? So those are good side for equity, and share you get. I'm mixing everything together. So we also have gearing levels. You have to be careful with gearing. If you are dependent on debt too much, you are killing your business because you are going to be highly geared. And when you are highly geared, you are sitting on a time bomb. Anything can happen to the business. So as a financial advisor, you need to know how to manage everything. That is your work, to be able to bring all these advantages and disadvantages from a broader perspective to make investment decision. So we move to distribution and retention, dividend and retention policy. Okay, businesses people have invested, we have shareholders. What kind of dividend and retention policy are we going to be using? Is it a stable approach? Is it a residual approach? Is it constant payout ratio or zero dividend policy? Let me just explain this thing very fast. Everything I'm telling you, it looks small, but I'm telling you, you're going to need it, because by the time you start seeing it at different places, you start appreciating what I'm explaining to you. I'm giving you a full overview of the broader knowledge of advanced financial management, right? Because you're going to be seeing all these things play out every time. So what kind of dividend and retention policy are we adopting? Stable. What's stable? Stable means that, okay, we're going to be paying 10 naira every year, right? So that's stable dividend approach. Every year 10 naira. So investors already know that it's 10 naira dividend I'm receiving every year. That's a stable approach. What's a residual? Residual means that, okay, yes, I'm supposed to pay you dividend, but it's not wise for me to pay you dividend just like that. Okay, we have made money this year. We have made 500 billion in profit after tax this year, right? But don't let us pay you just like that, right? I know you are expectant for dividend raise, you want more dividend and the likes, but can you allow us out of that 500 billion? We have other investment that we need to invest into. We have other investments that we need to enter into. Can you allow us take out of that 500 billion, right? For instance, maybe 200 or 300 billion and invest in those business. We have some things to clear. We have some things to do, right? It is the net of those things that we need to do. Whatever is now remaining, that is what we'll now share to shareholders. That's an example of a residual dividend policy approach, right? You can read up on all these things. I'm just giving you a picture of what it looks like so that by the time you're reading, you appreciate it. We've made 500 billion. We don't just need to pay all of you dividend or 100% dividend. Let us use some of this money to invest in other businesses. Because when we invest in other businesses, we are going to generate more return for you in the long run, right? So let us retain some for businesses and give you the remaining, so that by the time we are growing other businesses, you will enjoy the full benefit of your dividend in the long run. That's an example of residual approach. We now have the constant approach. Constant payout is that it's called constant payout ratio. Constant payout is that, okay, if I make 500 million, constant payout means that I'm going to be paying 10% every year, right? So if I make 200 this year, I'll pay 10%. 10% means that's 20, right? If I make 300 billion next year, I will pay 10%. I'll pay 10%, right? That's right, depending on the level of profit after tax. We now have zero dividend. There's some business that don't pay dividend at all. I want to ask, does this make sense at all? Anybody? Does this make sense? Zero dividend, not paying any dividend. Does it make sense? Anybody in the class, please? Why would some companies decide not to pay dividend? What's not the essence of going into the business or investing in the business when you're not going to pay me dividend? Can anybody assist with that?
Maybe the startup company. Maybe it's a company that just starts.
Okay. Okay, if it's a startup company. Thank you very much. Any other person again? Okay, so let me speak to that. All right. So thank you very much. If it's a startup company, that's an example. Yes, when the company just started, so they might not be able to pay dividend now because why? Whatever money they've made, they want to plow it back into the business so that the business can grow bigger and bigger, right? And should I shock you again? There are some business that are not startup companies, that are well-established companies, and yet they don't what? They don't pay dividend. Yes. And why is that? Yes, they're not startup. They've been in existence, and yet they don't pay dividend. Okay, so let me put it. So one, for instance, normally for an investor, right? I'm not only looking at you paid me dividend. Number one, it's not only dividend that is my benefit from investing in your company. There's something I expect, which is called shares appreciation, right? Shares appreciation. It means that if I invest in this business, even if you don't pay me dividend, there are some companies that don't pay dividend, yes. But I'm telling you, their share appreciation strategy is on point. There's some business that you invest, when you bought their shares, it was 10 naira. And within one year, it's already 1,000 naira. If it's already 1,000 naira, and let's say you've bought like 500 shares, you bought it at 10 naira, and now after 1 year, the shares is 1,000. Can you calculate the gain you've made on that shares if you sell at 1,000 when you bought at 10 naira? So for us to calculate the gain, it's just 1,000 minus 10 naira, right? Which is the cost multiplied by 500. Anybody can punch calculator and just quickly tell me, please, what's the gain? What's the gain on disposal when you sell those shares? You bought it at 10 naira and you are selling at 1,000. Anybody, please? Please, let's be fast, so we won't waste time. Like I said, you must talk in my class. We just have to engage you. You know, this is an online class. I can't see your faces, but my expectation is that the more I hear your voice, the more I see you are participating, it shows you are following in my class. Are we still punching the calculator or we didn't get my question? Anybody, please? Hello? Sorry, I don't know. Are we all in the class? Fulu, Kemi, Ok? I can't hear anybody, please. Or if we cannot answer, let me just know we're in the class. Is there anybody in the class? I can't hear anybody, please. Hello?
It's 45,000.
Okay, so that's 45,000, right? Oh,
Yes.
thank you. Trades for you are here with us. At least I'm happy I heard your voice. Okay, so it's 45,000. So it means that 45,000, it means that I've made a gain, right, on the business.
Yes.
So it means I've made a gain, which is so sometimes it might not be the dividend that you want to collect, right? But the ability that the share price would increase will appreciate, and you can sell it and dispose it and make a gain is also a strategy, right? So we need to understand that from that perspective. Also, another responsibility is communication with stakeholders. Stakeholders want to know your gearing levels. They want to understand your risk management approach. They want to understand the dividend you want to give them, and they want to understand the profitability you are promising, right, from this business. They want to know these things. Also, financial planning, control, efficient and effective use of resources. That is a key part of what the shareholders want to know. How are you efficiently using our resources? We've provided funds for you to run business. Are you using it effectively? That is part of the core job of a financial manager. And lastly, we now have risk management. What is the risk appetite of the business? Can it carry on big risk, or is it moderate risk or low risk? Like I said when we started, food business, what are the risks inherent there? Identifying those risks and mitigating those risks so that will not destroy value. Those are the full responsibilities of a financial manager. I believe. Can I move on? Is there any question from this part? Yeah, I'm with you. Okay, no question, right? All right. Thank you very much. Anybody with any question, please? All right, thank you. So I want to assume the whole class understand this part. Okay, so we move to maximization of shareholders' wealth. So, like we said, one of the major reasons one of the most important thing that a shareholder wants is maximizing their wealth. I invested 10 naira in your business. In the next year, what is this investment worth? How have you maximized my wealth? If I had invested in your company, right, what would my value be? What's the opportunity cost of investing somewhere else? That is what shareholders are interested in. So we have it here. Shareholders is the combination of dividend and share price growth. This is referred to as the total shareholders return. You know, I told you that there are some companies that their approach is zero dividend policy approach. They don't pay dividend, but it's the appreciation of the share price. So the combination of the share appreciation and the dividend that you pay me yearly, right? So let's say, for instance, now the dividend you pay me in this year is 5 naira. And when I did my share appreciation computation, share appreciation means that I want to see, okay, like I said earlier, when you calculated 1,000 minus 10 multiplied by 500, right? Whatever
Yes.
that gave you, that's 45,000, Abi.
Yes.
Yeah, that's 45,000. When you want to get total shareholders return, what you just do is that 45,000 plus the dividend you receive. There are some companies who will pay dividend, definitely, and share price will also appreciate. So that 45,000 plus the dividend I receive in that year, let's say maybe let's say I receive, let's just say I receive 10,000 naira. I'm just giving instance, 10,000. It means that my total shareholders return is 45,000 plus 10,000, right, for that year, divided by the amount I invested. Let's say I invested 20,000 naira originally, or 10,000 naira. Whatever you get is the total shareholders return. So investors are really interested in that. What is my what? What is the return on the investment? And it's not just only dividend. It's dividend plus what? Share price growth. Let's note that, please. Also, the company that provides the highest return for its investors will find it easier to raise new finance. So why will I go to, for instance, now, if you have been following the equity, the capital market and businesses, among all the banks, you will notice that GT share price is at the moment. It's been around 90 something naira or close to 100 naira per share. Whereas we have some banks that their share price is just 20 naira. Right? I think also you've been following that GT was recently listed on the London Stock Exchange market. Right? Big boost for its business, because why? It can mop in foreign funds very easy. What are we saying here? So it means that GT has put itself in a position whereby finance now. It has the leverage to raise finance, because why? People have seen the share price appreciation and they have seen the dividend that they are paying, which is high. So if I'm me as a business, I'm providing good returns to my shareholders, it will be easy for me to raise more finance, because more people will be interested in what? In investing in my business. But we now have something called agency theory. I know most of us are aware of agency theory, but let me just go through that and just a short explanation that has an agency relationship. Normally, who are those that report to the shareholders? Who are liable to the shareholders, first of all? Please, let's speak. Who are liable to the shareholders? Who are reporting to the shareholders? Who do the shareholders give their business to? Who? Hello? Sorry, I lost the person speaking. I'm with you.
Hello.
Yeah, I can hear you. You are saying something. Okay, I think I've lost you. Folu, I've stopped hearing you. Kemi, I've stopped hearing you. Ok, I've stopped hearing you. Awe Lawrence, I've stopped hearing you. Please, are we in the class? All right. So let's continue. Okay.
Just trying to move.
Okay. You're trying to what?
To move to a better place where there's network.
Oh, okay. Apologies. Oh, are you saying you've lost so many things we've said from the start?
Almost
you've been following.
But I'm trying to catch up.
Okay, not a problem. Well, the materials will be made available, so you can read up on that. Those are one of the it can be crappy and very discouraging. So, but let's just move on. I believe you catch up and with you. Kemi and Folu. Kemi and Folu, are they in the class? Kemi. Olu. Fidelis. Please give me a second. It's the plumber. I'm working. All right, I'm back. Okay, so let's move on. So can we hear me, please?
Yes, we can.
All right, so let's move on. So I was trying to explain agency theory, where, like I said, who are those that report to the shareholders? First of all, the shareholders, they have directors that manage their business. It's not shareholders that are in the business. Shareholders are external parties, but they hand over their businesses to what? They hand over their funds to what? To directors, to manage and manage effectively, right? So we have board of directors that are responsible to the shareholders. But there are sometimes that, like I said, the shareholders, what does the shareholders want? The shareholders want his wealth to be maximized. What does the director want? Director wants huge salary and good bonuses, right?
Yes.
Yeah, thank you. I would like us to be responding as I'm speaking, so I'll know you are active in my class, please. Yes, the directors, they want what? Maximum returns, right? Yeah. So they want what? Good bonuses. They want what? High profits. I said profits. High salary, right? But that there are sometimes that there's usually a conflict between what the director wants and what the shareholders want. And let me explain. Normally shareholders want maximization of wealth. And the maximization of wealth sometimes is not usually a quick thing. Like, it's not usually something that can be achieved in a year or in 6 months and going somewhere. Shareholders' wealth maximization involves investing in businesses that will generate return over time. So it can take like 2 years or 3 years or 4 years or 5 years, depending on whatever investment you are going into, right? And the appetite of the shareholders. But directors want to get paid on time. So what does directors do? Let's say, for instance, now, most directors, they get more money from their bonuses and maybe share scheme. There's some shareholders that will say, okay, because we want you to perform more in the business, right? We are going to tie you down with share scheme, meaning that if you achieve a particular target, maybe in terms of profitability or anything, right? Whatever metrics, you are eligible to, we are going to give you free shares in the company, right? Follow me, please. We're going to give you these particular shares. Also, if you make this level of profitability, we're going to give you this bonus. Maybe 10% of whatever profit you've brought in. So let's say the profit you've made for the year, let's say it's 100 billion. We're just going to make only 100 billion. Are we just going to make only 100 billion? No. We're not just going to make only 100 billion. We're going to try as possible to make what? 200 to 500 billion so that we can get 10% on 500 billion. Can you do the math of 10% of 500 billion compared to 10% of 100 billion? Is a whole lot difference. So what would directors do? Directors would try their best to ensure that they make 500 billion that year. And okay, was someone saying something?
So they will work hard to make higher profits.
Thank you very much. Thank you very much. I like you are following me. Yeah. They will work hard to make that money. But do you know that in their working hard, sometimes they try to do creative accounting just to achieve that purpose, if they've seen that they cannot achieve it. Do you know?
Oh,
Are you aware
I
of
don't
that? Some of them.
know.
What did you say?
How? How?
There are so many ways they can. Let's say, for instance, now, normally you're supposed to do a business. Okay, don't let me put it as creative. Creative accounting is part of it. But let me
Okay.
give you another instance. Let's say you're supposed to invest in a project that, let's say for instance, now let me give an example. You have an investment project that you can invest in, right?
Yeah.
That will give you in 5 years, right? In 5 years, you will get a benefit of, let's say, 1 trillion. I'm just giving you a hypothetical this thing. If I invest this
Mhm.
business in 5 years, for 5 years, after 5 years, I'm going to get 1 trillion, right?
Okay.
If I invest, the project will take 5 years, right, to enjoy that benefit of 1 trillion. 1 trillion,
Okay.
I will get 1 trillion. Thank you. If I invest a particular business, and now have another investment project that if I do it for 1 year, it will give me 200 billion or 100 billion. Let me say 100 billion, 100 billion. So I have 2 investment decisions. 1 year, 100 billion. 5 years, 2 trillion. Let me just say 2 trillion. 2 trillion, 5 years. 100 billion, 1 year. I want to ask you a question. Which one will directors be interested in? Let's start with that.
The one of 2 trillion.
Directors will be interested in 2 trillion, right?
Yes.
Okay, thank you. Does anybody beg to differ? Please. She has been the only one participating. I need more participation, please. Does anybody beg to differ on that point? Please, let's talk. Does anybody beg to differ? Okay. I want to assume she's the only one following in my class then. Or did anybody drop the chat? Okay, so let's continue. So yeah, you said directors will be interested in the 5 years plan. But let me now give you a twist. Do you know that if the
Hello? Hello? Are you there? Hello, sir.
yeah, are you following me? Can you hear me?
Yes, I can hear you now. Hello?
Okay, like I said, let's say for instance, let's see it a little bit. Okay, thank you. Let's flip it a little. Hello? Hello, can you hear me?
Yes, sir.
You can hear me now, right? All right,
Yes,
thank you.
sir.
All right. So let's say for instance now, I said, let's say for instance, where did you stop, please? Where did you stop hearing me so that you won't miss out?
You asked which of the investment will I go in? I said the one of 5 years, which is 2 trillion.
Thank you. Yes, thank you. From a director perspective, you said we'll go to 2 trillion, right? But
Yes.
and I said something that, I said earlier that we talked about if the director made 100 billion or 500. We said the director, they will prefer to make 500 billion because their bonuses will be very high. Abi?
Yes.
So now, for instance, now, this year now, right? This year, I said I said, we as a director, we are trying to make 500 billion so that we can get that 10%. And we have two investments. Investment A, investment B. Investment B will give me 2 trillion over 5 years, and investment A will give me 100 billion in just 1 year. Now, I as a director, what will I do? You told me that you are going to choose the one for 5 years as a director.
Yes.
I'm not telling you that there's a flip side to it, that there are some directors, they will not choose that 2 trillion investment. Why? This is the reason why they will not do that. One, they understand that if they go to that 5 years investment, investment that will take 5 years, they will enjoy the benefits of 2 trillion after 5 years.
Okay.
And they have to achieve 500 billion now. This year, we have to achieve 500 billion. So some directors, because of the bonus they want to get, they would rather go and do that business that will earn them 100 billion in a year to make up for the 500 billion they are trying to achieve, so that they can get their bonus that year.
Okay, and they can even invest.
And they can
invest with. I say with that also, they can also make some investment with what they made.
Yes, they can make some investments. But there's something you're not seeing. One, the investors have made the investment of 100 billion because they want to achieve their profits, their bonus target, right?
Yes.
But do you know that from a shareholder's perspective, they are killing the shareholders' wealth? Because shareholders understand that in 5 years, why will I make 100 billion in a year? Right? Let's say the investment they did, because they want to achieve their own bonus, the directors, they are doing business of 100 billion that will bring 100 billion benefits every year for 5 years. If they do 100 billion benefits yearly for 5 years, that's how much? That's 500 billion in 5 years, right?
500 billion, yes.
But if they have gone for that investment B that will generate a return of 2 trillion, is that not better than a 500 billion investment?
It is.
Return investment.
Far more better, yes.
It is far more better. So in that instance, can you see that shareholders, they've lost? Because of the director's selfishness, you've gone to do business of 100 billion. Now, because so that we can pay you bonus because you want to achieve 500 billion PAT, profit after tax. Whereas when you could have made 2 trillion for me in 5 years, and my shareholders' value will increase in 5 years by 2 trillion naira. Are you getting me? Hello, are you there? All right, so let's continue. So those are agency theory, right? Okay, you are back.
Yes.
Okay, you're also having network challenge, right?
Yes.
Okay, apologies as well. Okay, so like I said, so that is it. So those are things under agency theory, agency conflicts, agency costs that you understand as a financial manager. So we have responsibility from agents. For the shareholders, his agent is the director. Where the director is the principal, his own agent are the employees. What does employee want? Employee wants good life. Some employees don't want to work more, but they want something big, right? We have loan creditors as principal, we have shareholders as agents, right? So you can read up on agency theory, right, and understand more. Let me move on. We now move to types of risks and risk mitigation. In a business, there are two broad risks that are inherent in a business. We have the business risk and the financial risk, right? What is a business risk? Business risks just talk about the risks inherent in that business. For instance, like I started from the beginning. If I invest in in an agricultural business, right? An agricultural industry, for instance, what is the risk originally inherent in that business? One, weather. Weather is a risk, first of all, in agriculture. Because why? There are some, let's say, for instance, now, how many of us love plantain? You can see that recently plantain has been very right. It's not a season, and sometimes you will see it to be very cheap because it is season. So those are risks inherent in agriculture. Season, weather. Some people say, when it's raining, crops grow more. When it's not raining, crops does not grow. Those are what? Those are examples of what? Of business risk. Are you following?
Yes, sir.
Yeah. So those are examples of business risk. So as a financial manager, before we go into an investment, before we go into business decisions, what are the risks inherent in that business? Is it something we can manage? Is it something we can reduce? Is it something we can deal with? We need to look at those things. So I have here sales volatility, uncertainty with respect to the price and quantity of sales, and also the level of operational gearing, your proportion of your fixed to your variable operating costs. You can read that up. We also have strategies to reduce exposure to business risks. One, reposition the company product line into defensive industries, meaning that what? Those sectors relatively unaffected by the economic cycle, such as food, clothes, and pharmaceutical. So what are we saying here? Defensive industries. You know, there are some businesses that no matter what happens in the country, people must purchase those goods. For instance, food. Can we do without food? No. Even if there's no money, we must eat, we must buy food. So those are businesses that you know that, okay, no matter the level of macro issues that might happen in the country, people will still buy food, people will still buy clothes. The clothes might not be whether expensive or non-expensive, but are we going to buy clothes? We are going to buy clothes. Are we going to buy drugs? We are going to use drugs, whether it's expensive or not. Even if they call paracetamol 10,000 naira, we have no choice. If you have a headache, you will buy it. Yes or no?
Yes.
Yes. So you look at what? You look at strategies that you can use to reduce your exposure or mitigate your exposure. Also, your fixed costs, you can convert them into variable costs through what? Outsourcing and the like. So you can read up on all this. I don't know. I noticed that you are the only one active for now. I don't know where others are. Folu, Kemi, Fidelis. But let's move on. We have to move on because advanced financial management, there's a lot. So we just have to move on. Maybe they will catch up with the records and the like recording. So we have risk mitigation, continuation. So after I've spoken about business risks, now we move to financial. What is financial risks talking about? Financial risks is just associated with how a company finances its operation. What do you use? You use equity and debt, right? To finance a business. What are the risks inherent in it? If we do more of debt, are we not increasing the gearing level of the business, which is very risky? So we have to find that an optimum balance in our source of finance. The combination of our source of finance, the combination of of the equity and the combination of debt. That gives us our WACC, weighted average cost of capital. So for financial risks, it concerns the volatility of returns to equity due to the priority of fixed interest payments on debt, right? And this can be reduced by lowering the company's level of financial gearing. Although this should be balanced against the loss in tax savings. We also have other risks: credit default risks, reputational risks, fiscal risks, market risks, regulatory risks that a business can face, currency risks, dollar, especially if you are dealing with dollar. Today, you can hear that dollar is 900. You can hear tomorrow dollar is 15. So those things affect businesses. So as a financial manager, you need to know how you're going to mitigate this risk. And what are the ways? We have risk mitigation, hedging, and diversification. Under risk mitigation is just any action or strategy to reduce the impact or likelihood of risk or threats. We have management controls, hedging, or avoiding the risks entirely. We have risk hedging. Risk hedging involves you are trying to reduce the potential loss that can come from the adverse price movement. So for instance, now let's say when you bought a good, you bought it at I'm just saying dollar now. It's in foreign currency at maybe when dollar was 1,005, right? That's how much you bought the goods. The goods at 1,005 exchange rate. Now, if exchange rate has dropped to 800, and you want to sell those goods, are you going to gain or are you going to lose?
Going to lose.
We are going to lose. Thank you very much. We are going to lose.
Yes.
Yes, we are going to lose because when we bought those goods, we bought it at 1.5. Now exchange rate is 900. It means that in the business at a market, you can't sell it above the dollar range that is ranging of 900. You can't sell it because you bought it at $15. You now sell at 17. You will lose because why? Dollar has crashed. So we also have risk diversification. Diversification of risk is just, okay, how do I diversify my risks and not investing in just one industry? So there are some businesses that, for instance, is it good to go and put all my money into agriculture, the agricultural industry? Anything can happen to the agricultural industry, right? So rather than putting all my heads in one basket, I can invest in agriculture industry. I can invest in the food and
That's true.
beverage industry. I can also diversify my portfolio into into capital and equity market. So different diversification, not to just put my head in one basket. 4:49. So we're almost wrapping up, but can we just take like a 10-minute break and come back by 5? So we'll just have 1 hour more to conclude the session for today.
Okay.
Is that okay by you?
It's okay.
Okay, before I move on, do you have any question? And do you understand most of the things that was said today? I just need that feedback.
See, when I read up or understand more.
Okay.
The only thing I'm looking at
All right.
a way to mitigate the risk of increment in dollars in your business. Is there any way one can mitigate the risk? You get me right?
Your network is breaking. Come again.
Is there any way you can mitigate the risk of increment in dollars when you are dealing with dollars in your business?
Yes. Yeah. There's a way you can increase. And one of the tools we use in reducing the risk or mitigating the risks is what? Is derivatives. There's some derivatives, using of derivatives.
Okay.
And when we talk about derivative is just talking about, okay, if me and the buyer or a seller, because of exchange rate mitigation, we can decide to lock prices. So let's say, for instance, now dollar is currently 1.5, and I want to buy from you. You are going to deliver goods to me maybe in 3 months or 4 months. Both of us can lock the price of the dollar at a particular amount. Let's say in 3 months' time, I want you to sell this dollar to me at 1,007.
Okay.
Are you getting me? We can both agree and say that, okay, is at 1.7 you will sell that goods to me. Meaning that if anything happens after 3 months, whether cost increase to $2,005, because both of us have logged it at 1,007, that is what I will buy it at from you. Do you understand? Meaning that I've mitigated that risk, I've reduced that exposure.
Okay.
So those are examples of derivative contracts. We are going to be touching that also. It might be me, it might be the other lecturer, but those are examples of ways of mitigating risk, use of the derivative. We have the futures contracts, we have the forward contracts, and we have the swaps and spots.
Okay.
All right. So let's just take a 10-minute break and we continue from there.
Okay.
All right. Thank you very much.
Thank you.
Yeah, you're welcome. Okay. Welcome back, everyone. Anybody here with me? We went on a 10 minutes break. Fidelis, are you here? Okay, welcome back. Hello? Can you hear me now?
Yes, I can.
Okay, I was trying to say, can I know your name, please?
Become confidence.
Okay, confidence. Okay,
Yes.
confidence. All right. All right, so let's continue so that we can wrap up the session and call it a day for today. So I believe we lost others maybe because they had things to do, or maybe they will join back. But let's move on so that at least they will have access to the recordings and the likes. Those are the beauties of the online class. So let's move on. So we spoke about the business risks and financial risks, right? Which you spoke
Yes.
extensively on. Yeah. So we're moving to the next part now. So the next part is key accounting ratios. Do we still remember our accounting ratios that we use for financial analysis?
It's been long.
Do you still remember those ratios?
Not too sure.
Okay, which one can you remember in terms of classification?
I think it's been long that I went through it. just starting afresh because I left my profession to another profession.
Oh.
I'm into full-time teaching.
Okay. Well done. So, are you coming from ICAN or ACCA?
What happened? I've not even written any. I saw this online. I decided to join. Let me start with ICAN.
Oh, okay. So you just saw it online. You don't. It's not like you are currently writing the exam.
No, I want to prepare for the exam. Then
So which one
register.
Okay,
ICAN.
Okay, is ICAN you want? Oh, okay.
Yes.
So hope you're aware that this is ACCA.
Yes,
This is an
I
ACCA
know.
course. Okay.
Yes.
All right. Well, it's also applicable for strategic financial management in ICAN. So no knowledge is a waste is very useful.
Yes.
So yeah, it's very, very useful. So okay. So yes, you'll be needing this for your ICAN too. So let us talk about key accounting ratios for financial analysis. I want to check if others have joined. Okay, so Fidelis is here. Okay, you and Fidelis. All right, so let's move on. So we have under profitability ratios, we have different kinds of accounting ratios, right? And they are into 5 broad classification. We have profitability ratios, we have efficiency ratios, we have liquidity ratio, we have gearing ratio, and we have investors ratio. Those are the broad 5 classifications. So when you want to do financial analysis, maybe between companies in terms of comparables, okay, I want to check, how is GT performing? I want to check how is Access Bank performing. We can make use of ratio in understanding these things, how these businesses are performing, right? We can also do a trend analysis with ratios, right? Trend analysis being that, okay, this 2025, I want to compare between 2025 and 2024. That's trend. I want to compare for the last 5 years of the business. We started this business in 2020, and now this 2025, how have we improved in terms of our operations and our businesses decisions? So we make use of ratio analysis to get at. Though we know that ratio analysis have some limitations, right? But at least it will guide us in having a feel or understanding of how the business is performing. So what are the key accounting ratios for financial analysis? We have profitability ratios. Let's start with that. What is the profitability ratio? It's just value added being generated by an organization, right? So we've done this investment, we are growing this business. What's the value? What's the value that this business is generating? Those are things that profitability ratio speaks to. So we have one, return on capital employed. And how do we get return on capital employed? It's just the operating profit, because the profit speaks to the value that you've generated from the business, the profit we've made from this business divided by the capital employed. And capital employed, we're just talking about your long-term liabilities and your what and your equity. Long-term liabilities, which is simply what maybe your debt or bonds, whichever way you have used to raise debt, or what equity, right? Which can be through IPOs, or rights issues or anything. So those are the capital you've employed into the business to generate the value. So your operating profit divided by the capital employed will give you your what? Your return on capital employed. This is a very key metrics for profitability ratio. Note that. And what's your capital employed? Your capital employed is even your equity plus your what? Your long-term liabilities, right? Your capital employed can also be your non-current assets plus your net current assets. It's still the same thing. They will give you the same value. If you add your non-current assets plus your net current assets, it's the same thing as your capital employed. Your capital employed can also be total assets minus current liabilities. This is just math. If you open a financials or balance sheet, you can just do this small calculation and you see that they will give you almost the same answer. Either you are using your equity plus your long-term liabilities, or your non-current assets plus your net current assets, or your total minus what? Your current liability is employed. Are you following?
Yes, sir.
Your network is breaking. I didn't hear you, please.
I'm following you, sir.
Okay, thank you. And is my voice clear? Can you hear me clearly?
Breaking. It's breaking.
Oh, it's breaking.
Mm-hmm.
Is it still breaking?
Happily.
What did you say? Yours is also breaking too, but how bad is it?
It's not too bad.
Okay, all right. Thank you. Let's just manage. Next week should be better. I believe next week should be better. Okay, so we move to gross margin. So your gross margin is just your gross profit over sales, right? Those are your
Yes.
operational costs, right? Gross profit over sales. While your net profit margin is your net profit after you've taken admin expenses, right? Other expenses, right? Like depreciation and the likes, lightning and all those overhead expense. You have what? Your net profit margin, net profit over sales. All these things we've known it from university, even secondary school. So it's not, but it's just a refresher because you'll be needing it for this course. Yeah. So we have return on equity. So return on equity is different from return on capital employed, though. I want to ask, can you tell me the difference between your return on equity and your return on capital employed? What's the difference?
Return on equity employed. I can't. I have no idea. I have no idea.
You have no idea. Okay. Okay, so let me explain the difference. The difference between return on equity and return on capital employed is the presence of like long-term liabilities in return on capital employed. You know, I told you, if as a business, we want to look at the returns, that is the value
No.
equity and debt holders. Note, equity and debt holders. We make use of return on capital employed. It means that we're not only using equity for that business, we also have debt holders. So when we have debt holders, right, and equity holders, combination of two of them, the combination of these two factors generates the returns that we are using. So meaning that if I want to know the returns, right, we use return on capital employed to what? To estimate the value that has been generated by what? By capital holders and debt holders. Is that clear?
Yes, sir.
And we don't make use of profit after tax. We make use of profit before interest and tax. The reason why you're making use of profit before interest and tax is because you are trying to, normally PAT, you've taken interest portion away, meaning that interest that is due to debt holders, you've deducted it to get your PAT. And for PAT is used for equity holders. Is whatever is in PAT that we can give equity holders. But for debt holders, we would have given them their own money before we arrive at PAT. So when you are doing value for both of them, it's before that interest, whatever the company has before that interest, right? That is what you use to calculate that value. That's why we use PBIT, profit before interest and tax. But for return on equity, we make use of PAT, profit after tax. Because why? Profit after tax is the money available to only equity holders. But profit before interest and tax is the money available to interest and equity holders. Do we understand that? If you have an issue, I can come back.
No, go ahead.
Oh, thank you. Thank you. Because most students make that mistake. When they want to calculate return on capital employed, they go and use profit after tax. That's an error. You make use of profit before interest and tax. So we also have residual income. Residual income is your profit after tax less your operating assets multiplied by your cost of capital. We'll still talk about that later, but let's just know this as profit after tax minus your operating assets multiplied by your cost of capital. All these ones are used to maximize shareholders' wealth. To that maximization of shareholders' wealth. So let's move to another one. We've talked about profitability ratios. Now let's move to efficiency ratios. Under efficiency ratios, what does efficiency ratios do? It measures of utilization of current and non-current assets of an organization. So we want to see how you are utilizing your non-current assets and your current assets in terms of your cash, your trade receivables, your trade payables. How are you managing all those things? How are you utilizing it? That is what efficiency ratio talks about, right? How efficient you are as a business, right? Even in terms of there's this cycle. What's that cycle again? When I remember, I would say. So under that, we have asset turnover. We have asset turnover. Asset turnover is just your sales over your capital employed, right? We are dividing our sales by our capital employed. It's just for us to see how much we've done, what level of business activity we've done, right? By using our capital employed. What is the turnover of our assets? That is what asset turnover is talking about. And your ROCE is your margin times your asset turnover. Return on capital employed. Is it the same thing as margin times what? As assets times asset turnover. It will still give you the same formula for that ROCE that we got before, the one for the profitability under profitability ratio, where we have profit before interest and tax divided by your what? Divided by your capital employed. Sorry. So we have receivable days. Receivable days is just your receivable balance divided by your credit sales times 365 days. All these things are our knowledge, past knowledge. We've done this before. It's just payable days is just your payable balance divided by your credit purchase times 365. Inventory days is just your inventory divided by your cost of sales times 365. So you will need these ratios when you are doing appraisals of when you're analyzing a business. It might come out in a question, but it might not be full mark question. Just touch. So it's a cheap marks to get if you still remember. So please, let's read up on this. We have liquidity and gearing ratios. Liquidity ratio is just talking about how your total current asset divided by your current liabilities, right? How you've been able to manage that. And your quick ratio, you're just bringing in your inventory, because inventory, you cannot easily convert them to cash, right? So you are deducting your inventory from your current assets to divided by your current liabilities, right? To get your quick ratio. We have gearing ratios, financial gearings. We have debt over equity. We have a financial gearing. It can be debt divided by debt plus equity. Anyone is acceptable in the exam, just as long as you make the examiner understand that this is the one you are using. So sometimes you see some questions, they use debt over equity, right? And some questions, you see them use debt over debt plus equity. It's still the same thing. It will give you different answers, but you can use it. The exam. Yes, it will give you these different answers, but the examiner will accept it because they are speaking to the same thing. Do you understand? Yeah, because the examiner will accept it. So we have operational gearing. Operational gearing is just your contribution divided by your profit before interest and tax. So we have investor ratio. This investor ratio is very, very key. Very, very key in corporate finance. It is not to be joked with at all. Because why? That is what stakeholders are looking at. That is what shareholders are very interested in. Because this is what speaks to their own investment, how it affects them personally. So we have things like earnings per share, the profit after tax, what you've made from the business, divided by the number of shares, will let me know that, okay, this is my earnings per share. This is what I want in your business from an earnings perspective. Right? So that's what earnings per share talks about. We also have interest cover. Interest cover is saying, okay, by what amount of profit before interest and tax do you have that can cover the interest cost? Meaning that if your interest cover is high, it means that you are generating enough return to pay your debt. So investors like debt holders, bond holders, they will look at it that, okay, if your PBIT is very high compared to your interest, it means that you have the ability. It shows the number of times you are able to service your interest, meaning that you are liquid enough to pay your obligation. That's the meaning of interest cover. Your dividend yield. Are you saying something?
No, I'm just agreeing with you.
Okay, thank you. What does your dividend yield talks about? Your dividend yield is just your dividend per share divided by your share price. Okay, this is the dividend I what? Dividend per share. Do you know dividend per share is your dividend over the total number of shares, right? Divided by your share price will give us my dividend yield, right? The yield on my dividend. That's what this one. What the dividend I've gotten compared to the share price, what the business is currently worth in the market. Talking about my yield. My yield is my gain. What I'm getting. It can be 10%, it can be 5%. It just speaks to the yield. Yeah. So, and we have P ratio. P ratio is your share price divided by your earnings per share. So please go and read up on all these things. This is an advanced financial management class. So it's not a class where we have to be breaking all these things. No, we don't. There are too many bigger things to work on than this. But I'm just giving this as a refresher class because this is the first class. So we can start reading up and start reading wide. Yeah, thank you very much. So next, we move to limitations of ratio. What are the limitations of ratio? Different accounting policies can allow what ratios to not be easily variable, right? You can have different accounting policies that will influence your profit. So, in depreciation, there's something we call reducing balance and the straight line method. Are you there?
Yes, sir.
I know that straight line and reducing balance, the yearly depreciation is usually different. Do we still remember?
Yes.
I know that if it's different, right? The depreciation approach that you've used, if it's different, it will have a resulting effect on the bottom line, which is your profit. So let's say you are using straight line approach, and straight line approach now is 20. Let's say you have an asset of what 100 naira that is to be depreciated 5 years on a straight line basis. It means that yearly you are going to be taking 20, 20, 20, 20, right, for 5 years. And let's say you are using reducing balance approach. Let's say another company adopts reducing balance approach. Reducing balance, you are going to be paying higher in the first year, and it will be reducing on a yearly basis gradually. It means that if we are comparing two companies, let's say this company is using straight line approach, another company is using reducing balance. The one using straight line approach, you'll be using 20% depreciation to reduce his profit, right? Whereas his operating profit. Whereas the person using reducing balance with a high depreciation amount in the first year would have a more reduced profit than someone who is using a straight line method in the first year. But at the later years, the person using reducing balance approach would have more profits than the person using a straight line approach. I believe we know these things. This is just a refresher class. So, and if that is the case, it means that by the time I'm comparing two companies, the comparable analysis is not going to be perfect because why? They adopt different accounting policies. So we have different ratio definition. Like I said, ratio definition. An example is just what I just showed you now in the part of financial gearing. There's one formula that says financial gearing is debt over equity, right? Another one says you can also use debt over debt plus equity. Abi?
Debt plus equity, yeah.
Is it this one? Financial gearing, debt over equity, and debt over debt plus equity, like debt divided by debt plus equity. You can see two different definitions of financial gearing. So meaning that if company A is using this first one and company B is using the second one, they will both have different financial gearing ratio. Do you understand?
Yes.
Yeah, so it can distort your report. So, and whoever is using the second one, it will have a lesser financial gearing ratio than someone who is using the first one. You can try that test on your own. So, we have other reasons like possible deliberate manipulation. So, creative accounting. Some companies, they do creative accounting just to look good, whereas they're not actually good in the sense. So, by the time you're comparing with those companies will be acting as if they are better than you, but in the real sense, they're not actually better. They've only just they've only manipulated their books, and so on and so forth. Lastly, we now have different managerial policies. So there are different managerial policies that can distort the use of ratio analysis, the use of ratio data in making decisions. And lastly, we now have notes. I have this note: compare ratios with industry averages and other businesses in the same business. So what are we saying here? When you are comparing ratios, you can't say I will go and pick the airline industry and be comparing with manufacturing industry and taking their ratios. Are their ratios going to be the same? It can be the same because they're not in the same industry. What able to be manufacturing? They may have stock. Airline. What concern them with stock? Do you get it?
Yes.
Applicable in B. In airline business, it's usually they usually lease. In airline, their business model is leasing, right? Leasing. They lease a lot. It's not nobody buys a plane with cash. Most times they don't buy. It's usually lease, operating lease, or finance lease, as the case may be. So you cannot just go and be comparing in those industries, manufacturing and airline. You're only doing yourself. What you can do is just focus on an industry. If it's in manufacturing industry, what are the manufacturing companies there? Is it Dangote? Is it Bua? We can compare both of them together, Dangote and Bua, because why? They are in the same industry, cement business. I can do their Dangote cement and Bua cement and compare together, or Lafarge, as the case may be. So compare ratios with industry average and other businesses in the same businesses. Yeah, so that's all on limitations of ratio. And lastly, I will also be talking about weighted average cost of capital. This weighted average cost of capital is very important. Very, very important in finance, especially corporate finance. And in every aspect of the advanced financial management, we are going to be using the weighted average cost of capital. Are we familiar with weighted average cost of capital? Let me start with that. Or is it strange, or is it something we've come across before?
Strange.
Is what?
Strange.
It's strange. About I didn't hear you. Your network is breaking.
Strange.
It is strange.
Yes.
Wow. That's a well, at this stage, naturally, at advanced financial management, it's not supposed to be strange, because the expectation is that you should have done it in financial management, or you should have done it from ICAN at strategic financial management. But I'll just run you through, and you can read up on that. So what weighted average cost of capital is showing is just saying is that, okay, I have someone in the class, Steven. Steven, can you hear me? Welcome to the class. You can unmute and speak if you can hear me. Just to introduce yourself.
Yes, I can hear you. My name is Steve. Yeah, I can hear you. Sorry for joining late. I can hear you.
Okay. All right, not a problem. Not a problem. Thank you. Yeah. All right. So weighted average cost of capital. The average cost of long-term finance is known as the WACC, which is the weighted average cost of capital, right? And this is the formula. This is the formula for WACC. What is WACC saying? WACC is saying, okay, we have different sources of finance, right? Like we said, it can be equity, it can be debt, right? It can be shares, it can be stock, it can be bond. You can have a mix of both stock and bond, right? Bonds are debt, while stocks are equity. So combining both of them together is what you have to check what your weighted average cost of capital, meaning that you have to combine both of both of them together, because that is your capital employed to get your cost of capital. You know, in business appraiser, in investment, in business appraiser, that money that people bring in, the equity and the debt they bring in, is at a cost. So it's a cost to the business. So it's important that we must generate return that is above that cost. And what is that cost? That cost is what? The combination of your equity and your debt is what? Is your weighted average cost of capital. So you weight it. And what is the formula? We have VE. VE is your total market value of equity divided by VE plus VD, meaning that your total market value of equity plus your total market value of debt, right? That's the denominator. Just look at it as your capital employed so that you won't get confused. That denominator, see it as your capital employed, but the market value of your equity and market value of your debt, right? Multiplied by the cost of equity. When you cut down, it was at a cost. Equity, cost of equity is what? Do you know that cost of equity is the same thing as the dividend that you pay to shareholders? That's cost of equity. Hope you are aware.
Yes, yes.
Hello?
Yes.
Please, if you are confused, let me know. Yes, because cost of equity, when people buy shares and when people bring in money through stock, what do we pay them as returns? Is dividend. So it means that dividend is the cost that is associated with that what? With that equity.
Mm-hmm.
So that is that for the first side. Whereas you now add this plus your value of your debt, which is your total market value of debt divided by your value of equity plus value of debt, which is still the same thing as what? Your capital employed, but at market value, right? And you now take what? Tax sheet on it, which is 1 minus C. 1 minus the tax rate. Because why? Cost of debt. That's why when I started the class, for those that joined early, I told you that cost of debt is more cheaper sometimes than cost of equity. Because why? There's a tax benefit that you gain from what? From using what? Debt. For you to understand better, you can, when you go back to the class, maybe after this class, the recordings will be shared. You will understand what I've said concerning this part. So we now have where your value of equity is total market of equity. Value of debt is total market value of debt. Cost of equity is cost of equity geared. Please note, cost of equity geared. Sometimes we have cost of equity geared and we have cost of equity ungeared. Cost of equity geared means that there's an element of what? Of debt in it. While cost of equity ungeared means that we have stripped off financial risk. Cost of equity geared, there's a level of financial risk in cost of equity geared. While cost of equity ungeared, we've stripped off financial risks. But for WACC, we make use of cost of equity geared. When we move to concept like at APV, we'll be talking about cost of equity ungeared. There's a lot to learn in financial management, in advanced financial management, but it's so sweet. It does take your time. Don't be scared. Over time, you will understand it. So the cost of equity we use is cost of equity geared. Some students make that error by using cost of equity ungeared. It is cost of equity geared. Note that. Whereas where your KD is your pre-tax cost of debt, that is before tax. So T is your company tax rate. It can be 25%, 20%. So please read up on WACC. Next week, we are going to be solving questions on WACC just to set the tone. But you can go and do your extensive reading. So by the time we are coming next week, it won't be like magic or Greek. By that time, you'll be flowing with me properly because you've done your own personal research also. Because WACC is going to be used a lot in advanced financial management practice questions. So you have to understand it very well. So that's that about WACC, weighted average cost of capital. So in my next class, we are going to be solving questions on weighted average cost of capital. We are going to be looking at investment appraisals. And if time permits, we are going to be solving questions on investment appraisal. And lastly, we are going to be looking at questions relating to the role of a financial advisor, which we spoke about today extensively, financial advisors. So we'll just look at questions that can come out from those things that we've done today on the role and the responsibility of a financial advisor. Thank you very much. Any question before we wrap it?
Thank you so much.
So I would like to ask feedback from the class. What do you think, or what do you suggest in terms of presentation and communication? I don't know if you want to share something, being the first class, so that we can start on a good footnote in the next class.
The communication is quite okay. That's the network.
Okay.
Is giving us a problem. Voice is breaking. But the teaching is, the lecturing is powerful. Thank you very much, sir.
You're welcome. Thank you very much. So we'll meet next week. So by next week, I believe, and I hope to have improved on my network. I will see what I can do to ensure that it goes smoothly than this next week.
Okay.
And I'm assuring you that it will be better next week. Yeah. All right. So please let's read up once again. Please read up. I believe the admin will share the recordings to us. So, but please let's read up. It's very, very important. Advanced financial management, the best way to tackle it is to always read ahead of the lecturer, so that by the time you are coming, it won't look as if the lecturer is speaking jargon. So by the time I'm coming to the class, I'm fired up. I know what I'm coming to do. I'm just coming to understand better, so that when the lecturer is speaking, so it won't be as if I don't know what the So I wish you success in this financial journey.
Okay.
Like I said, it's very, very interesting and it's very, very sweet. Yeah.
Yes.
All right.
It would be better we have something like course outline, so that we can read ahead of our lecturer. Is it possible? Please.
Okay. Yes, it's possible, but even the course outline, even the course outline, this is the course outline. As you're looking at this, is the course. Okay, are you saying course outline on every classes, or the whole subject, the overview of the advanced financial management? Is that the course outline you're talking about?
Yes.
This is the course outline, no? This is the course outline.
Yeah,
This is it. Yes.
The overview.
Yes. This is the course outline of AFM. It's not more than this, but it's not broken down into different sub parts. But this is the course outline. This is what you are expected to know. But it's broken down into different subs. Okay. All right. So that's it. Yeah. Any other question, please? So please, like I said, this is what we're going to be touching in the next class. So please, let's read up on this aspect. You can screenshot this, you can note this down, but please read up, so that when we're solving questions, you understand better. All right. So since there's no any other questions, and I think we should call it a day today, right?
Yes, sir.
All right. So have a wonderful evening. Thank you very much.
Thank you.
Yeah.
Bye.
Yeah.